Okay.
Hello, hello. Happy Wednesday, everyone. Thank you all for coming. If you guys are on a computer, not driving, it would be great to see your beautiful faces. Hi, Sophie.
What's up?
Good to see you. Hey, Jeannie. Hey, Gary.
Gary, Freddie, what's up, man? Been too long.
Yeah, always closing all those deals.
I know. Like, yeah,
Awesome,
I just
that's
closed
for sure.
NASA today. I just closed Tesla today, this guy.
How you guys doing? Great to see you as well.
Yeah. What's up, man? We're just your high people, dude. That's all.
This is not hot because when you put
What's up? Yo, Randy, it's so trippy not to see you guys in the office backdrop. So loving seeing all you guys' beautiful faces. So if you guys can, would love to see you guys on video. Even if you're eating, I'd love to see what you guys are eating so I can get jealous. Eric, nice to see you. Thomas, you too, man. Thanks for getting on video.
Got some new faces here. Would love to hear, just type in the chat where everyone's from.
We guess a lot of Bay Area. This is my hot take.
Dale la mano. Dale la mano. Come over here.
I don't know where that is, but I'm in.
From New York City.
Oh, Jack, Bay Area. Oh, Jack, I thought you were in New York, man.
Oh, I thought the question was where are you from?
Oh, where you from? Okay.
I am in New
Area
York.
till you die.
Florida.
Oh man, well, thanks for coming so late.
Yeah.
Charleston, nice. Hawaii.
Hawaii.
What's up?
We have some great DCU coaches in Hawaii.
Go LA Rams. Oh man. All right. How do I boot Michelle? I'm gonna boot her right now. I'm kidding. No, I'm not kidding. It's too soon. Barbosa, what's up, man? Good seeing you.
What's up? Excited.
Yeah, man. Well, congrats on your newest deal, man.
I appreciate it, man. It's been a lot of work, but it's coming along.
Yeah. Well, man, dude, it's all the work that you put in, dude. Now you're just seeing the results. That's all.
It's true. That is true.
That is true. Well, cool. What do you think, Jenny? Should we kick it off right now, or?
Yeah, let's go ahead and get started.
All right. I know it's late out there for all you East Coast guys, so we'll make sure to get through this and make tax a fun thing to talk about, even though it never is associated in the same sentence.
What we're going to go over today, we've been ourselves, me and Calvin, and a lot of our students in our community have saved hundreds and thousands of dollars in different tax strategies and really be able to leverage and help us scale. We'll share about our journey and what we were able to do, but you guys are going to be so excited about taxes. We also have our amazing accountant here, Chris Becker with In-City Tax. He was a former IRS auditor, knows a lot of the different rules around the tax game. So we're excited to have him share about a lot about his knowledge and how he's been able to help us do what we were able to do, similar to what we say, the top 1%. Everyone, when you say like, hey, Donald Trump, he's barely paying taxes, but how is he doing that? There's a lot of legal ways that we're able to do to be able to save on taxes. And a lot of it is through real estate. So we're excited to share here today.
Yeah, guys, and I would kind of equate this to, hey, anytime you play a game, a board game, Monopoly, whatever it is, and I was just playing Monopoly with one of my cousins the other day who's a lot younger and actually knows the rules of Monopoly, and she crushed me, right? But just because she knew the rules, and that's kind of how I would equate taxes to. It's, there's a huge book on taxes that no one's going to read, but the people who do read it, if they know the tax code and they can help you navigate around legally, like what the tax code says and means, then you can use that to your advantage as well. Just like if you know the rules to a game like Monopoly. So to kick things off, guys, I love showing this because usually when I use the word or say the word taxes, this is usually the first thing that happens, right? They're like, oh, no, I'm out of here. Nope, I don't want to do that. And so, for all you guys, all 8 of you guys that have carved out the time tonight to spend your Wednesday night about taxes with us, y'all must be crazy. But y'all must be crazy in a great way, because obviously you know that there's something out there else for you guys. And I just want to honor you guys for taking the time out of your day to talk about this really, really sexy topic like taxes with us. Because I definitely know I used to be like this girl in this picture. Anytime I heard about taxes, I'd be like, oh, yawn, here we go. But once I learned, how you could use taxes to your advantage, I was like, I actually get super excited about it now. Like I talked to Chris, and Chris is our CPA, but if you ask Chris, man, he knows I text him, I call him all the time and talk strategy with him. So, and hopefully that's the feeling that you guys have after this call as well. It's like, hey, I'm excited to talk about taxes. I'm excited to see how I can use it as a vehicle in real estate in my life as well. So, who's excited? Let's see some faces. Let's get some energy up here, because again, like taxes, it's gonna be fun. It's gonna be real fun. All right, Eric, I see you nodding. I know you're all about it. I know Alex Lopez loves it. All right, guys. So what's on the agenda today? So we're gonna be talking about why real estate, just going over the basics of ways to make money in real estate in general, right? And taxes are gonna be part of that. Then we're gonna kick it off to Chris. He's gonna go over in more detail, hey, real estate in general, how it's treated for tax purposes. We're gonna go over cost segregation studies, use some real life examples, and then we're gonna go over how to actually scale a portfolio using some of these tax strategies that we're talking today. And I know that in the next 90 minutes here, we're gonna share a lot of information. A lot of stuff may even go over your head, but a lot of you may take this information and just roll with it. For some of you, it's gonna make a huge impact in your business and your lives. And for some of you, you guys are gonna want additional support and help. So, if you guys want that, I promise you by the end of this call, we'll talk about how you guys can get some of that additional support. All right, cool. And we'll make sure to answer any questions as well on the back end as well. So just quick introductions. Jenny, you want to maybe kick it off with, who we are?
Yeah, so just a quick introduction. My name is Jennie Locke, if you don't know who I am. I've worked with a lot of you guys, either helping you buy or sell a house in the San Francisco Bay Area. So formerly, Calvin and I actually met over at Oracle in tech, and we realized we didn't know what the heck we were selling out there, and it was pretty capped of what we can do there. So we decided to go into real estate where there was no ceiling, no limit, and I became a real estate agent, got my license. Before that, I actually bought my first house at the age of 23 years old, and in San Francisco Bay Area, which is a crazy hot market, and was able to buy a house through a home equity line of credit, put for the down payment, and then rented out the other rooms. And then that paid for the mortgage, for all of the mortgage, and was super excited because I barely had any expenses, and the property has gone up significantly since. So bought that for $870. It's already worth 1.5 million in just a short amount of time. So I was 23, I'm 29 now. So 6 years ago, and was awarded the Realtors Magazine 30 Under 30. We've sold now over 250 units. Last year alone, our team sold 120 units, families buying and selling in the Bay Area. And I think we have to update the passive income because Calvin's constantly closing more deals, and we have over 20,000 of passive income per month coming in. And we've built a network of real estate investors all throughout the country through Zen Coast University and coaching throughout. And really excited to share that. Initially, I'm from Brooklyn, New York. So people call me Jennie Locke from the block. So excited to share that. And another thing that I want to share is why I got into this. So that's one thing where I want you to ask yourself, why are you here today on a Wednesday night learning about taxes and real estate? And my big why is my parents. And my parents, they came out here in the 80s from China, not having much money, eating canned fish for dinner, only like a couple, like 1 or 2 meals a day. And they work in a garment factory and sewing clothes, doing laborious work. Still to this day, almost working 14-hour days, sometimes 7 days a week as well too. So I'm really excited to share through real estate. I am able to soon, in 2 months, they are going to shut down their shop of their garment factory and move out here to California to the house that I bought for them. And we're in the renovation process right now. And it's been a crazy ride, but it's actually only 7 doors house from my first property that I bought 23 years old, 6 years ago. So just seeing that, having 2 homes on the same cul-de-sac, and it's just been really able to transform our life and not really have to worry about money as much. I think that's one of the biggest factors a lot of people worry about, but now it's like we have that coming in so that we can do more for others and give back more for other people. That's my story, and I'll pass it to my husband, Calvin.
Yeah, I could never top that. I mean, essentially, I'm just glad that she married me, and that's my accolade. So we can move on. No, I'm kidding. Yeah, I mean, I guess a little bit background on myself for those who don't know me. I think I come from a very similar background to a lot of people, where we're taught, from day one of our lives that, to study really hard, to get good grades, to go to a good school, and go to a good school so you can get a good job, and then climb the corporate ladder until you're 65 years old, you're bald, you have a 401k, a golden retriever, 2.5 kids, and a fence, right? A white picket fence. And that's really what I thought success would be about, right? Was, hey, if I did those things, I'd be, quote unquote, air quotes, successful. And so, that's what I did, right? I got decent enough grades to get to a decent enough school to get a good job in tech, where thankfully I met Jennie. But what I found was when I got into that job, it wasn't all what was meant up to be. Like, I was climbing the corporate ladder, but I didn't feel happy. I didn't feel successful, right? I just felt like it was routine, day to day. And I was in tech, and really what I was looking to do is, all right, well, it scared the crap out of me to say, like, well, at the end of my life, is my legacy going to be I worked 35 years at this corporation, at Oracle, right? And that scared the crap out of me. So, a lot of what we did after that, Jennie and I, was like, all right, well, how can we buy back our time and our energy, right? Those are the 2 biggest assets that we have in life. And so, obviously looked at stocks, looked at cryptocurrency, but found real estate, right? And chose real estate, and really rolled with it. And in full transparency, we started reading the books, listening to the podcasts, things like that. But I know for me, at least, I definitely felt like overwhelmed. I felt an imposter syndrome. I felt this lack of confidence that I wasn't smart enough. Like, how do these Grant Cardones of the world, do this? And so, as part of tonight's session, what I want to do is I always love just sharing our journey. And again, I haven't updated this in a while, but a lot of you guys right now are somewhere along this same journey, right? And I love not only sharing the success, but I actually love sharing the mistakes, right? And the mindset shifts and identity shifts and the strategies that we've learned along the way to scale our portfolio. Because to be honest, that's where you've learned the most. And I love when people talk about some of the mistakes they've made, because it shows the growth. It shows the scar tissue that shows that, hey, I've done this for a while. And one of the things that we did early on in our career that I would never take back, but looking back on it now, like, it was a great mistake. But because we weren't confident enough, we weren't like smart enough, we felt, at least at the time, to do our own investments, we were like, hey, let's go find another investor and give them money, right? And Jennie and I had 100K in savings that we had at the time, and we gave another investor 100K to do a flip in San Francisco. And by the time the deal was done and we went to the closing table, she was like, hey, actually, I don't have that money anymore. I moved it over to another project without even asking us. And that was in 2015. So that was 7 years ago now. And yeah, we haven't seen that money since and seen her since. But I look back at that and I would never take that back, because it taught us such a valuable lesson of, like, what kind of investors do we want to be? Like, how do we want to take this prospectively on a mindset side of things? Do we want to just roll up and say, what, I never want to do real estate again. People were mean, screw that. Or do we want to roll up our sleeves and say, wow, that was a big mistake that we made, but let's make sure we never freaking make that same mistake again. And how do we make sure that, right? And how do we learn and grow from that? And so that's what we did. And we were able to scale up, buy more properties, made some mistakes along the way there, but guess what? Never made the same mistake twice. Did it again, never made the same mistake twice. 4th properties, 5th property, 6th property. We just kept on scaling around. And really, I test that to a lot about one, being around the right people, right? The right community. You are the 5 people that you surround yourself with. So, being around the right community to show me what's possible, to inspire me to say, hey, if they can do it, why not me too? Second was, hey, do I have the right knowledge? Like really, truly the right knowledge to give me the confidence to go take action, to empower me to take action. So I can throw the gasoline on the fire in our portfolio and really live the life of design, like Jennie mentioned. Things like tax strategies, things like leveraging partnerships, those things really helped escalate us so much more about just learning, I guess, the rules of the game, right, that I mentioned earlier. And then third is just having the right mentors, right, to catch you if you fall. It's always great to have people around you that you can call up and say, hey, what do you think about this? Am I missing something, right? Have you made more mistakes than I have? I love that in mentors. Like, have you made more mistakes than I have? And if they have, great, right? You can help me dodge those bullets that maybe you couldn't. And, I tell this story again, we're, I think at 161 doors now, but, not to say like, hey, like, look at us, like we're awesome, but really what I want to kind of mention to everyone on this call, right? Because everyone is on this journey, same as us, no matter where you are, starting in the middle, even more past us, whatever it is. One thing I think is super important always to mention is that I know early on in my career, I was always focused on achieving, I guess, a number, achieving a passive income number, achieving a door count number. And, obviously the goal was always the financial freedom. And I think for most people, that 10K a month number is always that financial freedom number for some reason. And that was for me too, right? But I was so focused on just like hitting that number. And in 2019, we hit that number, right? And I, expectations wise, as Jennie, like, I thought that our life would be set, we'd be happy, all that stuff, right? And to be honest, like, nothing of that changed. Our lives didn't change at all. Like, I was actually, probably more depressed than ever because I didn't have a purpose in life. I felt like, the age-old saying of, money doesn't buy happiness, right? It doesn't. It was empty, and I was on the couch just being comfortable. I was being complacent. And really, that's really when I found out the difference between being rich and being wealthy, right? Can anyone here tell me, and you can type this in the chat, can anyone here tell me like what the difference is of being rich versus being wealthy? And Jennie, if you can tell me, I can't see the chat right now, but you can tell me if anyone wants to say anything. And so I guess, my definition, as people put in the chat, but being rich just means, hey, you could just have a lot of money, right? But that shouldn't be the outcome. You have a lot of money, you can't be buried with money. But what I see about, people who are rich, usually it means that there's no balance in life either, where, they can be rich in money, but they're poor in their health. They're poor in their family life. Whereas being wealthy, in my mind, means you have balance in all aspects of life, because that's where fulfillment is, right? To have balance in everything, like money, real estate, all that stuff is just a vehicle to be able to use to spend time with who you want, doing what you want, right? When you want. And I know for me, I'm a butcher this quote, but the Dalai Lama has this quote that I've always remembered since I was a kid. And it just hit me so hard. But he basically says, hey, we sacrifice our health in order to make wealth. And then we sacrifice our wealth in order to buy back our health. And I was like, oh crap, like, dang, that hits me so hard, because like, it's so true. It's like a lot of people will just sacrifice their health, work long nights, eat unhealthily just so they make money. And then, they're not in great shape, and they have to use all their money to get back their health. And that's never living at all. And I think that's so backwards. So again, I want everyone to kind of take what we teach today and with the frame of like, hey, like, all this stuff is just a vehicle really to understand what your purpose is, understand what your why is, to be able to give back. And that's really what I think wealthy people do so well in general. And I mean, wealthy, again, that balance is they know why they're working so hard. They understand their own self-worth. They understand the bigger picture, but they also understand this abundance mindset where it is about giving back. It is about making an impact on other people, because really, you can have all the money in the world, but you could be completely empty. When you can give back and help transform people's lives, especially the ones that you love, your family, your generation, your kids, your parents, right? There's no better feeling than that, right? So as we go into today's call, just understand, like, what is your big why? And I'd love to also get some shares if people can unmute. Let's get 2 shares here. What is someone's big why? What are 2 people's big whys of why you're spending your Wednesday night talking about taxes and real estate with us? So I'd love to hear from 2 people before we move on, and I will call on people if no one volunteers. Going once. All right, I'll call on someone.
You're
All right,
meshing.
Freddie, man, you wanna jump in here, man?
Yeah, my pleasure. So I've got 2 young kids, and I really just envision just a life of adventure for them, a different type of life where I could take them and we can go for several years and go traveling. So I want to create a passive income stream where I don't have to work, and I can create that for them and be able to, even if we're not going the crazy nomadic life, because I know my wife will have a time limit to that. I want to be able to coach their sports. I want to be there. I want to be there as a big part of their upbringing, and that's just really important to me.
Mm. I love that, Freddie, man. It's all about family, man. I didn't hear Lamborghini. I didn't hear G6 once there, right? So I love it. Jay, man, I'm gonna call on you, dude, because I remember yours way back in the day that you told me, and it's something that really has stuck with me a lot as well. So Jay Miranda, man, if you're on the call, man, I'd love to hear why.
There we go. Hey guys, thanks for putting this together. My reason and my why is for my children, because I want to spend time with them. I want to see them grow. For me at least, time is more valuable than money. We can get money back, but we can't get time back. And I have 2 kids, my 6-year-old son Jack and my 2-year-old daughter Aurora, and they're growing up so fast. And I just don't want to be old and looking back at time and say, I spent all my life, all my time working, but I didn't spend quality time with my kids, and I just don't want to get old like that. And I want to be there for them and see them grow.
Yeah, I love it, man. And Jay, I remember one story you told me about that why, and why I know, like, for you, you've crushed in real estate, and why you will continue to do that. Was I remember Jack, your son, came up to you and was like, "Hey, Dad, can you drive me to school?" And you're like, "Hey, I can't. I got work," right? And that hit me so hard, man. And so again, like, that's what drives us, guys, to be able to say to your kid, "Hey, yeah, you want to ride to school? Absolutely, I got you. Let's roll. Let's get some ice cream after 2." Well, maybe not that part, but your wife will kill me when I say that. Well, cool, guys. So appreciate the shares, Freddie and Jay. Thank you so much. So how can real estate be a vehicle for you guys to make you wealthy? Not rich, but wealthy, right? Again, why we love real estate is, it's 90% of the world's millionaires are made through real estate. And it's something that the common person has access to, right? I never thought that I was the smartest kid in school. I wasn't. I think I was a CB student, but it's something that everyone has access to, right? If you learn it, if you dedicate yourself to it. And some of the misconceptions I had was, yeah, you have to be super, super smart. That's not always the case. And the other aspect is you have to have a lot of money. That's also not the case. So we'll debunk some of these myths as well as we go along this. And a couple of ways to do that is definitely through the tax strategies that we're gonna be talking about today. So on a basic level, guys, I just want to go over, hey, what are 4 main ways that you can make money in real estate just on one transaction, right? So there's really 4 big things. 1, appreciation. I think a lot of people don't understand what that concept is, but we'll go over that as well. Number 2 is cash flow, right? The net cash flow that you get after all your expenses on your property. 3 is your loan pay down. Hey, all of the rent that is going towards your mortgage, that's paying down your loan and mortgage every month, right? So building your equity. And then 4th is depreciation, that we're going to get even bigger on and expand upon that concept here tonight. So let's do a case study, guys. It's a little story here. All right, who here knows Zendaya or Zendaya? I'm probably saying that wrong, but anyways, I always love comparing different asset classes, right? Real estate versus stocks. Stocks are always something that comes up a lot. Maybe not right now, but people, that's probably the main thing that people invest in, stocks. So let's say Zendaya here has 20K to invest. What's her best course of action? Real estate or stocks, right? So let's compare. So on a first aspect, I mean, appreciation is always the one-to-one way to look at it, because that's a very much way how people evaluate stocks, right? So you get 20K and you buy stocks with that. You buy 20K worth of the S&P 500. Right? And on a 5-year average, make sure we get muted there. The returns on average are about 15% on average, right? So your 20K that you invest on a yearly basis, let's say it goes up to 23K, right? If you average out 15% return. So you make great, hey, great job. You made 3K. Woo. Now let's get real estate, right? So again, big part about real estate is that you can leverage. Let's say you leverage that 20K to buy an 100K house, right? And I'm going to give stocks their break here. I'll say the 5-year average on return on real estate, we'll say 8.9% appreciation. So not even 50%. We're basically taking that in half, 8.9%. So on the surface of that, you may say, well, stocks, you get 15%, that's way more, right? But here's the magic is that you get to leverage that 20K to buy a 100K asset and control a 100K asset, right? So even though it's appreciating almost half of what the stocks are appreciating at, that 8.9% that you leverage now makes your property worth 108.9K. So you just made $8,900, which is double the return that you made, even though you had double the percent return on stocks because you were able to leverage, right? So I don't know which one you guys would rather take, but again, here, real estate right there in my mind would be a better leverage tool right there because it's going to double the amount you can do. It's going to be able to buy properties that are way more than the cash that you actually have. So that's number one, guys, appreciation. Number two, you hear this all the time in the books, hear it all the time in Bigger Pockets, cash flow, guys. Say cash flow, cash flow, cash flow. It's awesome, right? So just look at cash flow as all the income that you get minus all the expenses you have in your property. And the remaining difference is the net that you get to take home, right? So again, you have a 100K property, your income, it rents out for $1,000, but your expenses, you have a mortgage of $600 and you have other expenses like maintenance and utilities and blah, 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 lawn care. Let's say that's $200. So your net on that example, you're getting $200 extra a month. Woo. All right. So now we have two ways that we made profit in real estate. We have the appreciation and the cash flow. But here's where it gets interesting, guys. So number 4 is a loan pay down. So a loan pay down is essentially, your tenant, you're paying you rent, but then you take some of that money and you pay off the mortgage with it, right? Every month. And every month you're paying down the amount that you owe in debt. So therefore your equity is growing and growing and growing. And so to kind of make that a little bit easier, again, so that same case study, it's a 100K property, you're getting $1,000 a month in rent, your expenses on your mortgage is $600. So part of your mortgage there is going to go toward principal and to interest, right? The principal is actually your equity, your interest is what you're paying the bank, right? But as your mortgage is getting paid down, as your tenant is paying your mortgage down, right? You're getting more equity, right? So now you have more equity that you can use to buy more real estate or do other stuff with, right? So if you look at this graph here on the left-hand side, like you'll see that, there's equity and then there's your loan, right? So in this case, it's a 100K property. You have 20K of equity of $80,000 worth of a loan. You got an 80% loan on that. Going forward, as your property, as you own it over time, your tenant pays down your loan over time, your loan goes down and your equity, guess what? Gets bigger. So now you have more equity in the deal. You have more equity in your net worth. So you have that to play with. You can refinance it, you can sell it, take it, exchange it, whatever it is, but you have more equity to play with. And on top of that, bonus round is that you'll have appreciation as well. All right, awesome. So now you're growing all this stuff right here while your loan goes down and down and down. So that's the magical part about real estate there. And the last one is depreciation. So depreciation, I'm not gonna get too deep in this because we're gonna go over this in nauseam here in a little bit. But it's essentially, there's a tax code that basically says that you can write off items to depreciate in your property. Things like cabinets, things like light fixtures that are not worth the same from day day one that you bought it new, right? So you can depreciate those items and write that off of your Schedule E, which we'll go over here in a second. But just a summary there, again, that 20K down can get you $8,900 a year in appreciation, or $2,400 a year in cash flow, $872 in straight line depreciation, and another $1,200 in your equity pay down. Right, so your total there, about $13,000 on your 20K down. That's a 66% return. Right, so that right there, guys, is the magic of what real estate can do with you on just one deal, and that's $13K a year. So with that being said, let's get to the real meat and potatoes of today. Is about going over taxes and how you can use real estate with your taxes. So that being said, we'd love to welcome in my good friend Chris /RCPA/absolute badass Chris. So I'll kick it off to you, man.
Hi, everyone, and thanks, Calvin and Jenny, for having me on. And it seems a couple times a year we always get together and talk about the fun and joy of taxes. So I'll tell you, can I share my screen, or how do I, or do you guys can pull that up?
Yeah, you can share your screen. You should be able to.
Let me figure out which one. There we go. Everybody see that? How do I?
Yep.
Guess I don't know how to full screen that thing, but that's close enough. All right. So tonight, obviously, we're going to talk a little bit about real estate and taxes. There are a handful of great opportunities right now that are going on, and things that we'll discuss tonight. Calvin and I have talked at length about some of the things that some of the topics we'll talk about. Some of you might be familiar with them. Always feel free to chime in, answer, or ask any questions that you might have. I'll start off with a little bit about me. Calvin always seems to want to mention that I own a Dodge Charger Hellcat, that that I do enjoy driving at a very rapid speed, so it's fun to drive. But to give you an idea, I spent the first 8 or 9 years of my career in medium to large corporate tax departments, doing a variety of things from state, federal, local taxes. You're talking companies from, single digit millions to $3 billion, revenue generating companies. So spent a lot of time working in the private sector of taxes. And then I spent almost 7 years as an IRS auditor in the small business and self-employed division. That division audits basically everybody up to 25 million in assets and 10 million in revenue. So I've seen quite a few things, seen quite a few different types of businesses, real estate professionals, hobbies, etc. You name it, I've seen it. Last 5 or so years, 4 or 5 years, I've been in the public accounting arena, and most of that's been spent as the owner of in-city tax. So I've enjoyed that. It's certainly something that has given me one of the things that I like a lot, which is to deal with people, and then try to help people to save money through a variety of tax strategies. So, and variety of opportunities actually. So for the next couple of years, we're going to have a 1 or 2 items that will really be helpful to some of you for real estate purposes. So, we can do pretty much anything for you: cost segregation studies, tax planning, tax preparation. We do the full gamut on the bookkeeping side as well. And then sometimes we do even have some special project work, or people want us to get involved in some of their deals. So I get involved in a handful of deals per year, 20, 30 deals where I'm talking with lawyers, looking at business sales, asset sales, those kind of things. So certainly spend some time in that arena as well. So let's jump right in. Talk a little bit about the number one thing that I believe everybody should do before they consider taxes, which is find the right deals. Some people find a deal for tax purposes, or the tax benefits are the reason they're taking the deal. Find the deal first. Find quality portfolio, beneficial deals, cash flow deals. Look at the deal and then look at the tax components of it. If you're weighing multiple deals, that doesn't necessarily mean you have to take the most tax advantaged deal. Look at the long-term benefits, the impact on your portfolio, the potential for growth, and some of the things Calvin's talked about as far as appreciation and other things that you can do. There's a lot of things to factor in, but start at the core fundamental of the deal and then work your way through the tax benefits, or potential accounting items or other items that could be beneficial to you. So never start with taxes. Taxes, to be fair, should maybe be second. Still very valuable, very important. A little bit tonight, what we'll talk about. We're going to talk about real estate and how it's treated, active versus passive. Talk a little bit about how you can become or turn real estate into an active activity as well. We'll touch on that a bit. Ordinary and necessary requirement. The IRS is pretty vague in how they define expenses, but I will define items that you can deduct. But I will tell you that over the course of the last probably 4 to 6 months, it has been the number one question I've been asked. What am I allowed to deduct, and what are the government requirements and rules associated with deducting items? So we'll talk a little bit about that. I have an example here of a Schedule E that I printed off from a taxpayer, from a client, so that we can just walk through what a Schedule E is and kind of how that works and where it goes, and where you can just to have a good understanding of where your rental properties will typically end up. And then cash flow generation versus taxability. there's a big difference between the number that you pay tax on or potentially would pay tax on and how that impacts your bank account. So we'll talk a little bit about that. Then we'll move into cost segregation studies and talk a little bit about how they can be beneficial for you as well, and what they can do for you. So let's just hop right in. Any questions to start before we get going? We good, do you think, Calvin? Just move right into it?
Right on, let's go.
All right. Active versus passive. This might be a little small. So active, the best way to think about active versus passive is active income is trading your time for money. I'm going to put, to the example that we spoke about, that Jay spoke about and that Freddie spoke about, is that, they want to have, they don't want to trade their time for money. They want to generate income and they want to use their time the way they want to. So active income is trading your time for money. If you own a business, you're trading your time for money. If you have a W-2 job, if you're at Oracle, if you're, anywhere working, like you're trading your time for money. And the benefit of that, from a tax perspective anyway, is that you can offset other active income sources, which is always seems to be the hot topic, right? Is how do I offset my W-2? How do I offset my spouse's W-2? How do I, get some of that income, lower some of that income so that I'm paying less tax? And again, we'll chat a little bit about that. Passive income, as I'm sure you're all familiar, is passive income is derived from a place you put your money, and then that money makes money. So you're not trading your time for money, you're trading your money for additional money. And that just puts you in such a beneficial position as far as your opportunity to build wealth and grow, as Calvin has mentioned. Some examples of this, and some of you will be in limited partnership situations or, be minority interest owners of S corporations, rental real estate. But the generally speaking, you're limited. You have limited involvement. You're not trading time for money. You are buying an asset that will generate dollars in cash flow over the course of time, and you get to sit back and do some of the things that you like to do. And one of those things is probably continue to grow your portfolio. So, and then the day-to-day operations and asset value growth. You have twofold income potential there, as Calvin had already mentioned, and I didn't realize he was going to steal my thunder on this one. So nice job, Calvin. Is, you're going to generate cash flow. So there's going to be cash flow and your bank account's going to increase, but at the same time, that asset is growing in value. So you have twofold growth potential that will take place, whereas trading time for money in an active income situation, that's not something that exists in that arena. So that's the difference between the two. From a taxability perspective, passive income, if you're not, we're just going to use real estate. So if you're a real estate investor and you're not a real estate professional, then you can only use passive losses to offset passive income. And passive losses have some limitations on how much you're capable of deducting in a given year. So there's some limitations there as far as if a rental property loses you money, what can I do with that loss? And we can walk through that as well. There's a slide here, I believe, later that will talk a little bit about that. Okay. Any questions at this point?
I got a quick question. What's the difference between passive losses and tax loss harvesting, if there is a difference?
Well, generally speaking, if you're tax loss harvesting, you're trying to find assets or things that exist out there that you have built-in losses on. The challenge that exists with those and with passive as well, there's generally no difference. It's just a matter of what's capable of being deducted. So if you tax loss harvest through the stock market and you say, I have built-in losses from XYZ, I bought Tesla at 1,200, it's worth 8, right? So I know it's built in there. Well, now now that's a capital loss, right? And you can't use a capital loss to offset active income. You can't use a capital loss to offset other types of income, right? Passive is the same rule. If I have a passive loss, then I am required to use that against other passive income. So really, the best way to think about it is there's really not a ton of difference between those situations that are generating losses, but how that loss is generated will dictate how that loss can be used. Okay. Any other questions? No? All right. Let's see here. I thought I had that, but let's move into ordinary and necessary. This is the, so when Calvin mentioned that there are people that read this stuff and try to understand it and do those kind of things, I will tell you that it is as boring as you can imagine when you get into starting to read the fine print of what's going on. But here's a great example of one of the simpler code sections to read. And basically 162A is the only one that matters. So this guy right here is the only one to really think about. And this is where I said the IRS isn't very specific, or the Congress isn't very specific in what is allowable and deductible. So their rule is, or the law is written that you can deduct any expense that's ordinary and necessary, and that's paid or incurred through the taxable year in carrying on any trade or business. And rental activities, whether passive or active, are considered a trade or business for purposes of this code section. Okay. Then they go into a few examples, but those examples again aren't really relevant to us. I just wanted to give you an opportunity to take a look at that. The one down here is the one to really, let's really dig into this one a little bit. So how do they define ordinary expense, or how do they define a necessary expense? And this comes directly out of off of the IRS's website when you start digging into some of the publications that they issue. Ordinary is anything that's common and accepted, and necessary is anything that's helpful and appropriate. Okay, so what I tell people is, or what I tell clients is, if you have to spend money or incur a cost in order to generate income, that is an ordinary and necessary expense for what you're doing. Okay, so if I own a rental property, some of the things that people think of are the direct costs, right? Well, I've got property taxes, I've got mortgage interest, I've got these expenses. Some of the things that don't always get considered, well, if I have a reasonable number of trips out to my property, as a result of repairs, maintenance, property management, et cetera, mileage is also deductible. That would be ordinary and necessary to the process of what you're doing. And that's not always something that people consider. And we'll show, or I'll provide a few examples of that. But in your mind, as you're working through deals, as you're working through opportunities, as you're incurring or generating revenue and incurring expense, if you ever have the question in your mind, am I allowed to deduct this? Is it something that is needed for the purpose of generating income? If the answer to that question is yes, that's a deductible item. Okay, no agent, no government organization, no one will challenge you as long as that is true. Okay, I will tell you, when in doubt, include it as a deductible expense in your financials, include it as a deductible expense to your tax person, and then put it as an item to discuss. But you'd be surprised. The vast majority of items, I mean, if you're not deducting the vast majority of your cell phones, if you own 10 doors, 15 doors, 20 doors, as a self-employed individual, I can attest to my phone does virtually nothing from a personal perspective outside of probably text messaging my kids. The rest of it is all business driven. So, which I'm sure you can all relate. So here's a couple examples. Some common expenses in the rental real estate world that exist out there. Keep in mind that you have to pay it. So if you're in a triple net situation, if you're in a different situation that may have the tenant paying for some of these expenses, just keep in mind that if you're not incurring the expense, you don't get to deduct it. Or if they're reimbursing you, then if you're going to take that as an expense, for example, if taxes are $10,000 and they're reimbursing you, then in order to deduct the taxes, you'd have to claim the $10,000 as income. Okay, but common operating expenses, right? Taxes, repairs, maintenance, utilities, interest, all of those kind of things will obviously be deductible. But again, a few less common items that are out there. Your tax returns with any properties on them, the vast majority of costs to prepare your tax return, if you hire somebody, is going to be driven off of your Schedule E, or if you have a Schedule C, or if you have a farm, or anything related to business. The vast majority of that cost is going to be spent in your Schedule E or your businesses. So make sure you're deducting a healthy portion. If it costs you $500 to have your tax return prepared and you have 5 properties, you should be allocating, probably $75 a property, of that to get yourself to $350, $400 of that expense, because that's where the meat of your preparers spent their time. Any accounting expenses that you incur, sometimes it can feel like a sunk cost and people miss it. I had somebody actually here recently who had a pretty sizable accounting program that they had purchased for, well over $1,000 for their real estate portfolio. Never deducted the expense on their financial statements when I saw it. And they just said, I didn't really even think about it. So, and then don't ever forget travel to and from your property, as we mentioned before. Don't forget that, because it is commonly missed. If someone sends me rental real estate and doesn't have mileage or some sort of travel on there, I will ask that question. Are these properties really completely managed without you? And you haven't visited any of them? Rarely is the answer, I haven't been to any of them. So make sure that you're looking at the time you spend traveling to and from. And keep in mind, if you're going to a rental property, it starts at leaving your door and ends when you get back to your home. So the costs incurred in between there are most certainly deductible if you need to fly because it's outside of there. And again, within reason, you can't go there 20 times because it happens to be in Maui. That doesn't work. But if you're going out there to get eyes on it and make sure everything's good to go, and you go out there once a year and you're out there for 3 days and you got someone that put in a furnace, air conditioner, whatever, 100% deductible, like no issue there whatsoever. But it's all facts and circumstances based. So make sure you talk to your CPA, your tax person, to understand what would be allowable on those trips if you have any questions. All right, so that talks a little bit about what expenses are and what you can deduct, what could be or should be on your tax return. We've talked a little bit about active versus passive. So let's talk a little bit now about, well, how does that get to your tax return? What does it look like on your tax return? One of the things that I want to make sure everybody understands, and I didn't put it in here, is limited liability companies do not exist for federal income tax reporting purposes. Okay, they're disregarded entities. What does that mean? That means if you set up an LLC for every single property, those LLCs are not going to appear on your tax return. Just the property will show up on your tax return. For federal purposes, they don't exist. Okay, it's a very common misconception. It's a question I get a lot. Well, where's my LLC? Your LLC, your single member limited liability company, will not show up on your return. Let me see if I can get, Calvin, do you have any magic? I guess I don't run PowerPoint hardly ever. On where I just
magic you want.
Where I make this,
on the
where you can
bottom
just
right.
view the whole thing. You know what I mean?
Yeah. So bottom right hand side. Oh, go back out. Bottom right. There's a little
Go over.
Yeah, right. That one right there. Yep.
And then some quick questions while we have in the chat. Do out-of-state property flight count for family members if they're looking at evaluating their properties?
That's a tough one. So this out-of-state, so this family member would be just going along for the ride, or is this person also involved in the same thing? Are we asking a question about, if my kids came along with me kind of thing?
Ideally kids, yeah, but just curious how far you can toe that line.
The reality is you would qualify, sure. If the IRS was going to take a look and evaluate your trip as a whole, the requirement or the rules associated with trips for business purposes would be it's required to be the predominant reason you're there, or generally speaking, the business purpose has to be predominant. Meaning, if I go out to, let's use Maui, so I go out to Maui, I have 2 properties out there. I need to be out there for 2 days for that purpose, but then I'm out there for 10 days. Well, that's not predominant. That's not predominantly the reason I was out there. So you have a smaller portion that would be allowable as a deduction, if any. If you're asking if the family members can be deductible, the family members cannot be deductible. in that example, unless you have a business reason for them to be there. It doesn't mean they can't go, and it doesn't mean you still can't have the same business purpose, and it doesn't mean you can't spend time or turn it into something else. That's fine. You would just have to allocate a portion of it to personal versus business purpose. So I'll give you a great example. I went out and did a cost segregation study in North Carolina, and my son is a massive LaMelo Ball fan, and my daughter is getting to the age now, as obviously several were mentioning. She had her 17th birthday yesterday, so she's getting to the age that she's going to be evaluating if she, where she's going to go to college. So I said, you know what? I'm going to Durham. We'll go check out Duke. We'll go check out a couple of universities, and we'll go catch a Charlotte Hornets game. So my portion of the trip, the flight, well, I was going there for business purposes, and I was there for 2.5 days. So my flight was deductible. My hotel, I took 50% of the hotel, and I took 50% of the rental car, and any of the gas expense that we incurred, because we didn't really have to go too terribly far for college purposes or to the game. That was business. The rest of it, though, was personal. Does that help? Oh boy.
Yeah, sorry, I was on mute. Yes, perfect.
Oh, you're fine. I can't. This thing. Can you all see my screen?
Yep, we can see it.
Okay. So you're probably going to look at the side of my face because it moved to my monitor. So I do apologize for that, but hopefully everybody can see this better. Any other questions? Jenny, you said there was one or two? Or are we good?
Someone asked about retroactively tracking miles if they haven't been tracking them. So
Okay.
How are we able to do that?
Awesome. Mileage is not required to be kept contemporaneously, meaning as you do it. However, I would strongly encourage you to do that. But if you have not, we do have some great tools in this day and age. Fortunately for us, via email, calendars, Google Calendars, whatever format you're using, your cell phone. So you can go back and track mileage just as long as you can go back and track the reason why you were traveling. So a great example would be, hey, I went out to this property, or I looked at these 3 properties on a random Tuesday, Wednesday with XYZ Realtor. I went out with Jenny, we looked at properties, great. I drove 200 miles, but I didn't keep track of it. But I bet you have an email chain with Jenny that would tell you that you were going to go visit properties. I'll bet you've got the day, nailed down somewhere in those emails or that communication that says, hey, here's when we're meeting and here's where we're meeting. And then you can turn around and you can kind of backtrack yourself and do that to determine how much mileage you have. I'm going to tell you what I do for mileage because I realize I'm an accountant, but I hate receipts and I hate tracking things. It's awful. And so I totally feel anyone's pain that says, hey, you know what, I don't have all my receipts. I get it. So I've come up with kind of a little bit of a cheat for travel. Obviously, I have all my appointments in my calendar that are on my phone. But what I did is I set up an account, an email account that is like in-city mileage, or I also operate a basketball program where it's playmakersmileage@gmail.com. And every single time I travel, I send an email with the subject line of where I went, how many miles it is, and then obviously that triggers the date for me. At the end of the year, I just go through and I add up all the subject lines and then I move it into the folder for that particular year. And I'm done. I can do it. And I probably don't spend an hour for the entire year for all the travel that I have between both businesses. And another thing that I use for receipt purposes is I use an app on my phone called Expensify. I very much like that app. You just snap a screenshot of it and it dumps it into a bucket, and you can go through and sort those buckets and do some different things when you get there. I'm sure there's 1,000 different versions of it, but that's the one that I use. And then all those receipts end up, I just recycle all the receipts. I don't keep many of those. But I am very diligent about making sure that every single time I go somewhere, I shoot myself a quick email. Every single time I spend any money for business purposes, I snap that receipt. So that's my process and method. It works well for me, and it keeps me from having to go back and sort through things and figure things out. I can upload that directly to any accounting program that I need to in order to get it dumped in for bank account purposes, or when I pay my credit card, or however I purchased it. So it's pretty straightforward. Just a couple tidbits for you business owners and real estate investors. Try to save yourself some time. I know how valuable that is. All right, so any more, Jenny, or are we good?
We're all good.
Okay. All right, so let's walk through and talk a little bit about what the Schedule E is. If any of you aren't familiar, this one is, I chose this client because it's a perfect representation to talk about both profitable properties and properties that are not profitable, and how you analyze it, what are you looking at, and then at the same time, this is also a great one to demonstrate the difference between how much money you make and would have to pay tax on, and how much cash flow you would actually receive related to a property. So in this particular example, as you can see, I mean, again, I assume all of you are capable of following along here. This just your rents received. Here's your core expenses that came through. Here's your bottom line profit or loss on the particular property. Okay, so made 8, lost 17, made 13. Okay, the net here is $4,400, lost $4,400. Okay, so I want to, and if there are questions related to real estate professional status, I most certainly will answer them. But we'll talk a little bit about the difference in what you can deduct if you are a real estate professional versus not a real estate professional. But the main takeaway here is you subtotal all of your Schedule E's before all of your properties before you determine whether or not you have a profit or loss. It is not pocketed or taxed in any way, shape, or form in each of these silos. It is a net number. And if you had 50 properties, then you'd go, however many that is, 15 sheets deep, and then you'd subtotal them all and come up with a number at the end. All right. So this is the passive investment. Supplemental income basically means passive. All right. So any questions here? Any thoughts? Anything that's not making sense to anyone that I can help explain, or can we move on to the nitty gritty of this page and the next one? Good. All right. And we'll go back and forth a little bit here, but as you can see on column A, that column A made $7,755. That's this one right here. Okay, so that's the profit in that particular entity. That'd be considered net income, right? So for this example, I did just silo it and pocket it. But depreciation on this property is $5,313. That's right here. Depreciation expense or depletion. Okay, so keep in mind depreciation is a non-cash item. I realize some of that goes back with your mortgage payment, but that's a non-cash item. And in this particular example, this particular client has no mortgage. They own this property free and clear. So this particular property, for tax purposes, made $7,755, but your bank account increased $11,517. Okay, so this is a great example of what Calvin was talking about opportunities to make money and then compound that on top of appreciation and on top of other things. So how do we get to $11,517? Well, here's our rent, here's our expenses. You add back your non-cash because you didn't spend that in money, that didn't come out of your bank account. But then again, if you siloed this, don't forget you would have to pay the government. If it's the only property you had, you'd have to pay the government. And we'll just say 20%, that's $1,500. That's how you get to $11,500. So it's important, very important, to understand the cash flow of properties, as well as understand the rest of the market forces that could be beneficial to you as an investor. So always run or get a cash flow analysis of the property before you get in there. Obviously, it helps them a ton that they don't have a mortgage, because they're not having to outlay for the interest piece and not have to outlay for the principal. But regardless, the difference here of whatever that ends up being, about $4,000, that's money in your pocket that you don't pay any tax on at all. Now scale that. This property is $160,000, $80,000. Scale that into 10 versions of that, 15 versions of that, 20 versions of that. You can take $4,000 in this particular example. You can take $4,000 across however many properties you get, and really grow your portfolio with just the gap between what you would have to pay tax on those properties and what you're collecting into your bank account. So that's, and I'm just talking about the 4. I mean, that's not whether or not you even want to dip into this. I mean, you could, maybe it's, I'm going to take 50% of this. I'm going to take $5,500, $6,000, and I'm going to move that into additional portfolio growth. So it's a great opportunity just to understand that you will have more money in your pocket than you will have at the bottom line of your return, generally speaking. Very important concept. So again, here's another example. And I took this with the same client, it's just their 4th property, is I wanted to kind of silo this and show you that there's a loss here now without other ones around it. There's a loss here now. And I wanted to talk a little bit about, if you're not a real estate professional and you are a passive investor, this client is a passive investor, and they lost $7,865. There are limitations to what you can deduct. Okay. Now the government, if you make less than $100,000 from a married perspective, if you're married, if you make less than $100,000, they will give you an active income offset of up to $25,000. So if you make $90,000 and you lose $7,865, they'll let you take that $7,865 and reduce your 90. Even being passive, the government will let you do that. It's an awesome benefit, right? However, between 100 and 150,000 in that example, that limitation phases out 2 to 1. Every $2 it goes down by $1, to the point where the 25,000 just phases out at 100. If you make 150,000 or more, married filing joint, you're not allowed to take any of the passive loss on your return at all. It's 0. Okay, so that's how passive investing will work on your tax return if it's flowing through a limited liability company or personal ownership. Now let's move that. Well, let's take the loss and let's follow that concept all the way through. That loss will always be able to be used against other passive income. So you can carry it forward in future years and use it against other passive income. So if the next year this exact property made $7,865, you would not pay tax on it in that year. It would be 0. And then the following year, if it made money, you'd pay tax on that. All right. So let's take it and move ourselves from the passive investing side to a real estate professional. And a lot of times people ask me, and I talk about it a ton. I talk about it 100 to probably 200 times a year with prospective clients, is what are the rules for real estate professional and what is it and how does it work? All right. No one ever gets to the point of, well, how does it show up on my return? So when Calvin asked me, can you put an example of a Schedule E in here? I kind of was excited about it because now I can show you how being a real estate professional would show up on your return. So let's take, for example, and let's make this easy. And let's say instead of $7,865, let's say it's $78,650. So no matter what, you wouldn't get it all. If you qualify as a real estate professional, down here on oh wait, hold on. Where am I? My one sheet away. Here we go. I'm sorry. On this sheet here, this is page 2 of Schedule E. On this line 43, you can see reconciliation for real estate professionals. Okay. If you have limited losses as a passive investor, but when that's loaded into the tax software, you load it as a real estate professional. So in my example, it was $78,000. That minus $78,000 would show up right here on your tax return, and you would get to take that against active income on your tax return, right? So this is the place. If you're a real estate professional, this is the place it's going to show up. All right. So before I continue, does anyone want me to talk briefly about what a real estate professional is and how you meet the requirements? It's pretty simple and doesn't take a lot of time.
Let's quickly review that, and then we have about 3 questions in the chat.
Sure. All right. A real estate professional requires 2 things. First, you're required to work 750 hours within the qualifying real estate time. And that is generally and more commonly broken down into 4 or 5 categories. The most common of those categories are development, redevelopment. They are property management, construction, and operations. Those are the main 4 that people seem to run into. So if you spend time on brokering, brokering would be the fifth one. If you spend time in those fields and more than 750 hours, then you have the potential to qualify for a real estate professional. The second qualification is it has to be the thing that you do more than any other work activity. So it has to be predominant activity that you do. So if I have a W-2 job, and let's just say I'm a doctor, and I have a contract to work 1,000 hours, I would have to work 1,001 hours of qualifying real estate time in order to be considered a real estate professional. If I don't have any other activity that I'm performing, and this is all I do, well, then I would qualify as a real estate professional as long as I did it for 750 hours in a year. All right. So with that, and when we start moving our way into cost segregation studies, which is next, that is where the power of being a real estate professional and conducting a cost segregation study starts meeting how do the 1% do it that Jenny was mentioning. So we can work through that. So that's that's what it takes to be a real estate professional. And this is where you would find it on your tax return as you are working through your return with your tax professional. Jenny, I'm happy to answer any questions at this point.
And going back to the Schedule E, does the property need to be in an LLC to be in a Schedule E?
Absolutely not. Oops. Absolutely not. So right here, right here, all you're going to see is the physical address. If it's a limited liability company, single member, just you, it is also just going to be an address here. You would never put the limited liability company in there. I mean, you can write it, but it just doesn't matter. So all you're doing is address. And if you own it personally, you're putting the address there. If you own it as a single member LLC, you're just putting the address there. But the answer is no, you don't.
Perfect. And regarding Airbnb income on your investment property, is it a passive or active income? And does it change if your Airbnb business is under a LLC?
It's not going to change if it's under an LLC, but it is going to be fact dependent. A lot of Airbnb or short-term rentals end up on Schedule Cs as active businesses. So a lot of it will depend upon the fact pattern of where you're at. But generally speaking, those become active businesses for trade or business purposes. They rarely lose money. That's a completely different world as far as opportunities for investment are concerned. Just because you're not charging $1,200, $1,500 a month in rent. I mean, you have the potential to scale, $220 a night times 30 nights kind of thing. So depending upon how it goes, those ones do a little bit better. But generally speaking, those end up as active Schedule C businesses.
And can you touch on the tax implications of being a passive investor versus being actively involved in the property management and repairs for your property?
So that would just go back to whether or not you could qualify as a real estate professional because of the level of your involvement. If you have the capability to get over the threshold, that would be the difference. If you can't, if you have a 2,080 hour a year W-2 job, you're not going to qualify as a real estate professional. And it doesn't matter how much time you put into the property management, to the repairs, and to the tenant locating, you're just not going to get there because, to be fair, the IRS will just never believe that you're working 4,161 hours. They're just not going to buy that. So the reality is, if your fact pattern allows you to go from I'm basically a passive investor that's limited in involvement to, I'm only working about 800 hours a year elsewhere, and now I'm going to start managing these properties myself. I'm going to start directing traffic. I'm going to start working through the repairs and maintenance of these properties, et cetera, then yes, then it would flip you or potentially flip you to the real estate professional status, which would give you the opportunity then to maximize your tax benefits based on what's allowable out there today.
Some things, if you can highlight a little bit more about what Calvin and I did when Calvin was still on his W-2, we got married and did our taxes together and was able to offset since I was a real estate professional. So sure. That's something that a lot of people do. Hey, if one partner works from home or has more of a part-time job, they can get their real estate professional status easier, and then it will be able to roll over into the other spouse.
Correct. So to Jenny's point, only one person on a tax return needs to qualify as a real estate professional. But what it would require is it would require you to ensure that the ownership of those properties, the management of those properties, et cetera, was done by that particular person. So if you're setting up limited liability companies, in Jennie and Calvin's example, those limited liability companies would be heavily favored toward Jennie. Because if they were 50-50, well, then Calvin's portion wouldn't qualify from a real estate professional status, and he would have limitation, whereas Jennie's 50% would qualify. And so if, let's just say, depreciation was $100,000 or the loss was $100,000, Calvin's would be fully limited because, would be fully limited if their income was in excess of $150,000. But Jennie's portion of that loss would not be limited in any way, shape, or form. So it's important that you understand, to Jennie's point, first, only one person has to qualify, and you can then offset real estate losses against your spouse's active income. But it is important that you structure that enterprise to heavily favor, if not fully favor, the person that would qualify. So if you have someone who is, stay-at-home parent, those kind of things, a lot of times what will happen is they will become the property management, the coordinator, they'll do the research, they'll deal with the realtors, they'll do all those kind of things. And then, you jointly make decisions, and then you end up in a 95-5 or 100-0 ownership structure with the person that would qualify as a real estate professional. And then you utilize the cost segregation study, you utilize, losses on those properties to offset someone's W-2 income.
And then just a reminder for everyone, you don't have to be a real estate agent to be a real estate professional, just investing in real estate. And another question is, does this loss offset benefit still apply if you also have other sources of income, job, unrelated businesses that bumps you over the threshold?
If you're a real estate professional, then any active income that's generated on your tax return for any purpose would be capable of being offset. One of the things that is not required is there is no income requirement. So if you lost $20,000, $100,000 in real estate, but you made $1 million working 100 hours in some other industry. I mean, I had 2 clients who probably worked 250 hours during COVID and had fortunate ties to just buy a whole bunch of PPE equipment and just made millions of dollars. But they didn't really do anything. They didn't do a whole lot, and they still qualified as real estate professionals because they didn't spend a ton of time in it. So any active income, anything that would be considered earned, meaning if you have a Schedule C, if you have an Airbnb, if you have interest, dividends, all those kind of things, all of that will now qualify as offsettable if you are a real estate professional.
And then if we keep rolling over our passive losses, can we use that to offset capital gains when we sell?
Yes, any losses that exist within your property basically trigger at the time of sale. So the year you sell a property, kind of all bets are off, because the best way to think about it is you're not really using that loss in any way, shape, or form, but your basis just hasn't been reduced, right? So let's just take depreciation for an example, and let's just say I have the first year I bought a property for $200,000, and I'm going to take $100,000 of depreciation, and I just have this massive loss I can never get over the top of. Let's say I have $50,000 of that loss left, right? So if I bought it for $2 million and I took this $100,000, right? So then you would have said, well, my basis is $100,000 when I sell. So if I sold it for $250,000, I made $150,000. But the reality is you didn't utilize all of that $100,000. So you bought it for $2 million, you claimed $100,000 of depreciation, didn't utilize $50,000. So really you only used $50,000 of depreciation in that example. Therefore your basis is $150,000. So it basically just gets lumped back into your passive loss would get added back to your basis number before you calculated gain. But you will not pay gain on that loss portion. That's true.
And quick question, and then we're going to go back to everything. So I'm an active real estate professional, but I have an S Corp that pays me a W-2. Does that mean I can't qualify as an active?
It is an active. Again, the only requirement is in that, well, okay, a realtor, and you're getting paid as a realtor as a W-2 on W-2?
So she has an S corp that pays herself a W-2.
Okay, and then that S corp
She's a
is
realtor.
paid via 1099 from whatever companies she's selling through or he's
Mhm.
selling. Okay, that is a completely different situation. You are still considered to be self-employed. You still can meet the rules associated with being a real estate professional. You're working for the S corp, but that does not disqualify you from real estate professional status. Okay. What would disqualify you from real estate professional status is if you were doing exactly the same thing that you're doing for your wholly owned S corp for a company. So if you went and worked for Keller Williams and they paid you a W-2, that's different than setting up your own S corp and then paying yourself out of the S corp. Okay, so that does not disqualify you to being a real estate professional. To be fair, the vast majority of real estate professionals that I know either have a limited liability company set up or they have an S corp set up. And you would still qualify.
We'll go back to the rest of your presentation.
Okay. All right. So let's jump into the 1%, the thing that everybody that can qualify and can utilize, thing that everyone is doing at this point for the next 2-ish years or so. Everybody's going to be running cost segregation studies. So what are they? A cost segregation study is an analysis of a property that you buy and moves that building value from long-lived real property, meaning 27 and a half or 39 years. 27 and a half is if you're buying residential rental real estate. 39 years is if you're buying commercial. It moves it, some of it, from 27 and a half or 39 into 5, 7, or 15-year property. So basically, when you start the cost segregation study, let's just utilize a single or a multifamily residence that you buy for $1 million or buy for $1.2 million. $200,000 is land, so the building value is $1 million. That building depreciated over 27.5 years. Okay, that's how you start. That's the core of how it all works. Now, a cost segregation study comes in and says, hold on, not all of that property, not all of that $1 million is really 27 and a half year property. Some of that is personal property. Some of that could be a parking lot, which is 15-year property. Some of that could be exterior signage or lighting or specialty electrical, which is, potentially 5, 7, or some of it 15 years. Landscaping, for example, would be a 15-year asset. Okay. But you're buying it all in one lump sum. So the cost segregation study comes in and says, hold on, we're going to put this into the buckets that it belongs in based on the type of property that you have. Okay. Why is that important? It's important because of the tax law that was put in 2017 that took effect in 2018 that allowed 100% bonus depreciation on assets with lives less than 20 years. Okay. So if I take an asset that has a full $1 million that has a 27 and a half year life, and I move $300,000 of it into the 5, 7, and 15-year bucket, I now can deduct $300,000 in year 1 because it qualifies for bonus depreciation. Okay. And if I also qualify as a real estate professional, I now have a $300,000 deduction against all the active income on my return. And we'll walk through an example of this. I actually have it. I pulled one that we've done. And I have an example of it that we'll walk through. But I will tell you right now, for anyone that can meet real estate professional status, this is without question the #1 thing being done around the country. No question. If you are buying real estate, this is the #1 thing being done, no matter what dollar value you're buying it for. Taking the cash flow right now, taking the deduction right now, the time value of money, taking that money and putting it into additional deals in other places is far more valuable than burying it for the next 27 and a half years. Okay. So here's an example. This is just the cover sheet that someone would get. This is a property that we did apparently in Maui. I'm kind of hung on this Maui thing apparently. I went in January and it's in Wisconsin, so it's not warm. So I'm hung on that, I guess, a little bit. But here's an example of a property that we went in and did in there, that I went and did an analysis on. And what will it provide? The report will provide you with a detailed, clear breakdown of what you will be allowed to deduct. Okay, so here's kind of your summary page. All right, so this just gives you an idea, talks a little bit about it. But the number one thing that you see here is your bonus depreciation number, 4.8 million. This particular client went from having probably about 600,000 in depreciation to having a $5 million deduction in the first year. Okay. This is your deduction. This is not a credit. There's a big difference between tax credits and tax deductions. This is a deduction. If this particular client made $5 million, they would be able to reduce that by $4,797,577, and then pay tax on the difference. So this is what gives you a rough idea of how to reclassify how the property was reclassed. So in this particular example, the total amount and value of the building was 17,171,000. That's this number right here. Okay, so that's the amount of the building value that was analyzed to say how much should be 5-year, how much should be 7, how much should be 15, how much should be 39. And you can see here in the optimal analysis, you can see that 1,602,000 went to 5, 0 went to 7, and 3.2 million went to 15-year, with the remainder being 39-year property. All right, so here's that 4,797,000 that you saw before. All right, so where is the biggest bang? Like, where's the bang for your buck, and how do we know how much money something like this saves us? That's right here at the top. Okay, this particular client moved $4.797 million into their depreciation column. Okay, and it saved them in taxes $1.5 or $1.6 million that they would have been paying in taxes had they not done the study. Okay, so beforehand, $1.6 million check going to the government. After the cost segregation study, keep the 1.6 million, go buy another property. Okay. Now, downside. It's not going to be around forever. As with all things that are good, eventually they got to come to an end, right? So tax law is never built to be permanent. And if something's costing the government too much money, they are more than happy to resolve that problem by changing the rules. So that's what semi happened here. Property acquired after this date, right? You're allowed 100% bonus depreciation. However, starting January 1, 2024, it's going to move from 100% to 80. And then every year subsequent, 80 to 60, 60 to 40, 40 to 20. And then after 20, it's gone. Okay. So when I said before, like over the next 2-ish years, people are still going to be heavily leveraging this real estate planning tool. Here's why. When it gets to about 60%, when it gets to this 60, it still can be valuable, but you have to have the right type of property and the right amount of money invested into it in order for it to make sense for you to do it. So you have to have the right facts and circumstances. When you start getting down in, I mean, no one will be running cost segregation studies at 20%, unless they're just hard, in a very limited cash situation where it matters that they save every penny, because the studies aren't free. They do cost. So this is the one thing to keep in mind if you're looking at a long-term opportunity to get yourself to be a real estate professional and take advantage of cost segregation studies. Keep in mind of this timeline. And Calvin, I am happy to send you this presentation so that anybody that needs to reference it, you can send it out to everybody on the call, so that anyone needs to reference it, they're welcome to reference it. All right, Jenny, do we have any questions at this point?
Let's see. So someone says, they own a few homes, they do their own taxes. Are they a real estate professional? They manage 2 of them, but property managed for another. So I guess like to answer that is really depends. Do you have another job?
Sure.
Um,
Yep. I mean, are you doing, is the amount of time you're spending in real estate more than the amount of time you're spending doing anything else? And is that at least 750 hours of qualifying real estate time, management, property management, operations, those kind of things? If the answer to that's yes, 100%, they would qualify. Yep.
Then if a property was bought this year but doesn't take cost segregation until 2 to 3 years later, is it still 100% based on 2022 purchase?
It's gonna be in effect at the time you do it.
Okay.
Okay, so if you wait, then it's gonna be in effect at the time you do it. The other thing to keep in mind is if you do it in a subsequent year and you claim depreciation, and I realize this is gonna be a technical breakdown, but if you own a property and you establish a depreciation method and you get multiple years down the road and then you say, you know what, I want to run a cost segregation study. You're required to ask the government, and it will be automatic, but you're required to file a form 3115 and do a change in accounting method. Then in order to deduct the cost segregation study, you wouldn't get it in the year. So let's just say you did it in 2024, so it's 80%, and you wouldn't get it all in that year. You would get, if your deduction was $1 million, you'd get 250,000 in the current year plus 250,000 over the next 3. It's what's called a 481A adjustment and is the result of your change in accounting method. But if you establish a method for more than a year and you then want to change that method, the IRS has to approve it. Again, depreciation changes will be automatically approved, but then it requires a 4-year roll-in of your expense. You don't get it all in the first year.
Let's say we're in 2023 and we can depreciate 60% of it. Does the other 40%, we can do it over the 27 and a half years or 26?
Oh, 100, absolutely. Yep. The remainder is whatever doesn't get accelerated into the current year will still be depreciable. You'll still have depreciation. It will still exist for the whole 27 and a half years. You're just taking some of that depreciation and moving it up to give yourself the time value of money, to give yourself the cash flow now. You're entitled to the deduction regardless. If you kept the property for 28 years, you'd be in exactly the same position, except for you got more money up front.
What's the cost of a cost segregation study on average?
Generally speaking, depends upon the value and type of property, but you'd be hard pressed to find one for less than 3,000. If you get into large commercial properties, some of those can be 20,000.
And then do cost segregation analysis apply to people who have no path of being a real estate professional status and they only own a few properties?
But not for tax planning purposes, they don't. I mean, if you did it, basically you'd just be putting yourself in a position to not have to pay tax on that property, making money for the first probably 12 to 14 years of it, sure. But to be fair, you're probably not really doing a ton to save yourself. You're not doing a ton to really save yourself any money because you're just going to sit on a big giant loss over the course of time. You're going to increase your income for the remaining years. You're going to offset it with the loss. I mean, really the first 12 or 14 years, you're not doing much. It wouldn't be valuable for you if you were not a real estate professional. If someone doesn't qualify as a real estate professional, I cannot in good conscience tell them that a cost segregation study is beneficial.
If someone bought in 2020 as a primary residence and it's now a short-term rental in 2022, can they do a cost segregation on it?
Sure.
Okay.
Sure. An analysis would have to be done on the value of that property. What are you going to use as your basis? What did you transition it? You know, how did you transition it into whatever entity you got? I mean, you'd have to determine what you can use for your cost. Sure. But absolutely, if you turn it into a business asset, not a problem.
Will they lose out on the IRC 121, which is the 250,000 or 500,000 capital gains tax exemption if they do a cost seg?
No, not necessarily, but you are getting yourself into an extremely complex calculation getting out of that thing. If you do it and you still meet the 2 out of 5 requirement and you then have to depreciation recapture the difference, you're going to get stuck into a minimum tax calculation number on that depreciation recapture. So it can be technical and it could be it could not be or it could not be beneficial to you in that particular situation. So you're certainly getting yourself into a sticky situation and in a complex calculation situation if you do that.
If I will be doing real estate professional and planning to do 1031 exchange a couple properties that have $30,000 in repairs and improvements, should I do a cost seg if I am planning to sell in the next 2 to 3 months, since tax will continue to be deferred with 1031 exchange? Probably not.
No, in that particular example, I mean, you 1031 it, you push the gain into another property, you reduce the basis of that property, and to be fair, then you cost seg the new one.
Awesome. And then, no, you do not need to have an LLC for a real estate professional.
Nope.
And then, is cost segregation still feasible due to a small single family home valued at 200 to 300,000? Or is there a certain number that makes sense for property over time?
But really, you have to look at your facts and circumstances and what you're trying to do. I have people that have cost segregated $140,000 property because they're going to push together all the cash they possibly can so they can go out and continue to leverage that capital to go buy more assets. So it just depends upon your facts and circumstances. I mean, if you're in a situation where cash generation is important so that you can continue to grow your portfolio, I don't know that there's a floor. I mean, you have to look at what it costs to do the cost segregation study and make sure that, you know, the benefit is there. But at the same time, like, you know, it all depends upon where you're at and what you need to continue your process.
Let's say it's 2025 and we do a cost segregation, then can we go back and amend 2021 taxes?
There is no carryback.
No
They
carry.
eliminated the carryback.
Okay.
Love the gas though.
Believe me when I tell you, I have a lot of clients that were, you know what, we're gonna create these cost segregation studies and we want to run them back 2 or 3 years, and just unfortunately the government got that one right. They got that one right.
And you miss 100% of the shots you don't make, right, Chris?
Yeah. It was worth asking, that's for sure.
And is it worth to take an use accelerated depreciation or bonus depreciation if they plan on selling a rental within a few years? And what about depreciation recapture?
What I'll say is, if I have a lot of clients who turn over properties on a consistent and regular basis, and they will 1031 those properties and other properties. And generally speaking, you don't end up in a hard hit, if any, depreciation recapture situation if you kind of play the 1031, you know, roll it to the end game and continue to cost segregate and use that as an opportunity. If you're out of the cost segregation, the big benefit, let's say you're looking at 2024, so you're at 60%, or 2025, or you're at 40%. Now you really have to run the analysis to see where you're at, because you may not be able to offset the depreciation recapture calculation through getting acquiring the new property and then trying to find benefit associated with the new property. So for the foreseeable future, I don't think most people will get caught in depreciation recapture situations unless they are not planning to buy anything else. Unless they're not planning to, if you're not going to 1031, then yeah, you're going to be in a depreciation recapture position.
And Calvin, I would love for you to share what 1031 exchange is, an example of what we did. If you can share your slides.
Yeah, because I'm gonna share a couple of slides here real quick, but I think it's really cool to just start to talk about, guys, like how we use a lot of these strategies that we talked about with Chris, and how do we actually use that to scale your real estate portfolio too, right? So, Chris, can I share my screen?
Yeah. Oh, there we go. I got you.
There it is. There it is. Thank you, sir. All right. So again, I mean, there's so many ways that you can scale, and again, like everything that we talked about with Chris, you utilize, right? But now, how do we relate that back into, all right, now how I scale my portfolio in real estate to get my time and energy back? So we talked about accelerated depreciation. That's 1. 2 is refinancing properties, and 3 is the 1031 exchange, right? So to Chris's point here, you know, if you can't qualify as a reps and you actually take advantage of accelerated depreciation, then, you know, keep that momentum going, right? And use your tax savings, not to buy boats or a Lamborghini or a Hellcat. Sorry, Chris.
That's all right.
But use that the savings that you're gonna get on the taxes using the accelerated depreciation and cost segregation study. Use that to buy more real estate. So let's say you're saving, in that example, Chris, the guy was saving $1.5 million on his tax bill that he just doesn't have to pay Uncle Sam. Well, the good thing is that he could actually use that $1.5 million, leverage it, go buy another $10 million asset or $8 million asset, and do what? Cost seg it again the next year. Now, again, every year it's going to go down, but again, he's going to be able to use that to not pay as much taxes year over year until 2027 when it's phased out completely. So one way to continue to scale that, guys, is again, continuously be able to use the money that you're saving. Don't buy boats, don't buy the Lambos, use it to buy more assets that you can depreciate again and do it again and again and again until you can, especially this year. So I know Christy always tell us, hey, this is the year, buy as much real estate as you can, right? Because it's the last year you're gonna have 100% bonus depreciation. And the other aspect too, guys, is when you sell properties, what happens? Right? You're gonna pay that cap gains tax, right? So again, we're always about how can you defer taxes until you die, right? And so if you have an example here, if you have a $500K property that you purchased it for, it's worth $1 million. Your profit's $500K. Again, you're gonna have a lot of different tax basis things, depreciation, things like that, improvements, blah, blah, blah. But for easy example, let's say you netted $500K of profit there. You might pay cap gains up to $150,000. Your profit there is only $350K, right? And so we don't want that, right? We want to defer that. We want to keep on using that to build more assets. So to have your assets, buy more assets. And the other way to do that then is to refinance, right? So instead of selling your property, if it's gained that much value, just refinance it, because you can avoid paying cap gains tax, because the IRS views a refinance not as, they view it as a loan, right? Not as a gain, right? So that way it's not taxable income, right, Chris? I'm not gonna put words in your mouth, but that's how I understand and interpret the tax laws on refinances.
No, there is no tax implication to a refinance.
All right. So in that same example, guys, you have $1 million valuation in your property that you bought for $500K. Let's say you had a $375K loan on it when you bought it. You refinance it at a 75% loan to value of $1 million. So you get a loan of $750K. You pay back the original loan at $375K, and you're left with what? $375K to invest, and you still own that original property that can continue to grow as a seed. So now
and keep in mind, everyone, that there is a $750,000 interest or interest on $750,000. There's a limitation there, but that does not apply in real estate investing or businesses. It only applies to your primary residence. So, and some of you might have been thinking, okay, well, he's saying $1 million, I can't deduct all of that. No, you can. You can, and you can do it at each property level up to whatever the loan is on the property. So you have no limitation as investors. You have no limitation on the interest paid for those assets.
Yeah, gotta love real estate. Another reason to add to the list, guys. So I mean, here's an example that we had. Right, we had a property that we bought for $870,000. We refinanced for $1.24 million. We actually cost segged this property as well. Thanks, Chris. And we pulled out $300K, right? And we use that $300K to buy multiple other properties with, right? All these different properties across the nation, and the equity gain on these properties, from this refinance was over $200K in gain already, and over $2250 of cash flow net as well. So again, we're just deferring, we're taking out cash, not paying tax on it, and buying more assets with it. And now these assets are growing as seeds as well that we can continue to grow until we want to refinance those and use them to buy what? More assets, right? So that's the second way, guys, refinancing to avoid, paying taxes. Third, like Jenny mentioned, is the 1031 exchange. So again, this is a tax incentive from the government that allows us to defer our cap gains as long as we're buying equal or more exchange of a property, right? So you'll have 45 days to identify, 120 days to close, but this is a way for the government to incentivize investors to keep their money rolling instead of just taking it and putting it in the bank account, right? So the easy way to say it, I'm not going to go over the legal Irish jargon of it, but defer your cap gains till you die. Roll it over to the next property. And it's a powerful way that mom and pop operators just like us can continue to buy a single family home into a multifamily, into a bigger property, and keep on using those same dollar amounts that we initially invested and in the equity gain that we made to buy larger assets that gain more cash flow, more equity. So some of the examples that we have of that, this is actually one of the first properties I ever bought, right? It was cash flowing about $100 a month, but hey, you know what? It actually had a lot of equity in it. It was worth about $200K when I sold it, right? And I had about $95K of equity in it. So what we did was we didn't take the cap gains in it. What we did was we 1031 exchanged it into another property and bought an apartment complex with that $90K of equity we had in it. That cash was $3,700 a month. And we just got an offer on that we bought a year ago. And it was like $640K of equity gain in 1 year, right? So again, that's still the original capital I used. I think I put down $35K in the initial deal. And then I had almost $100K of equity that we moved in to buy a bigger property. So as people always ask us, how do you scale up? Using these asset refinances, 1031 exchanges, accelerated appreciation, using that cash to buy more assets, you're again using all the assets that you have to buy more assets. Right. And so you continue to build and get bigger, and get bigger, and get bigger.
Hey, Jenny, I saw a question from Peter about what happens when you die. One of the, I guess the verbiages that exists out there is you basically 1031 everything till you die, and you pass it along to your heirs, because your heirs at this point anyway would get what's called a step up in basis for the properties that you have, which means if you bought it for $100,000 and it was worth $1 million the day you died, the basis to your heirs is $1 million. So if they sold it the day you passed away, then they would have no gain on it whatsoever. Then $900,000 in my example is completely sunk from a government taxability perspective. Okay. Right now, there's about an $11.6 million lifetime exemption that can be transferred in that particular example. If your portfolio is massive, there are going to be some tax implications to that portfolio, but let's just say you have $10 million of fair market value of property, and you have $2 million of cost in that property because you've depreciated in 1031 and done all these different things. Your heirs will pay $0 on that 10 million, that $10 million worth of asset transfer.
And Tina asks, is it better to have their names on title?
Whose?
Let's say if we're adding our kids on title for all of our properties.
I mean, only if you want them to pay tax on stuff.
Yes. So our recommendation, like my recommendation is just if they don't need to be, they're not on the loan and or anything, and you're able to get the home yourself, then do not have them on title, because then they don't get the benefit of the stepped up basis, because only half of it gets stepped up. Let's say you bought something with your son, then only 50% of it gets stepped up to the value, but the other of the 50%, you still have to pay taxes on that. Versus like having that $1 million home, then when I pass away, then they can inherit $1 million cash without having to pay taxes.
Yep. Yep. Keep them off if at all possible. And if you are going to put them in some sort of the different benefit position, I would work to try to do it through a trust.
And every single state has slightly different things regarding when inheriting, but every state should have like the stepped up basis. I know in California, when you inherit a rental property, your property taxes will get reassessed if you're not moving into the home. So that's where a lot of people are transferring their real estate and selling during that time. But it's still going to be stepped up. So if you have any family member that passes away, you do want to get an appraisal of the day of death. And there are some appraisers that are able to do a backdate if you didn't do that. So that is very important.
Awesome, guys. Well, I know we went a little over today, and I know we went through a lot of information. So thank you, Chris, so much for
appreciate it. Thank you
for that. But you know, one of the things that we always say is, hey, we've taken in a lot of information. You guys have taken and sacrificed the time to be on these calls to learn about taxes in general. You know, the worst thing that you can do is not take any action, right? So we're always about, hey, in moments of decision, that's when destiny is shaped. So what that means for us is, hey, go out, no matter what it is, like find one freaking thing that you took from today's call and go take action on it. Talk to your CPA. You know, hey, do I qualify as a reps? Can I use cost segregation? Like how can I deduct stuff from my ordinary or passive income, right? So the worst thing that you do is not do anything. So if everyone can just promise me that you guys have invested the time already today, just go out and please do one thing that'll get you further along in your goal of real estate. And I know that we promised at the beginning that we'd share what we can do to support, right? Because again, I know we went through a lot of information. So, what we do as well here at Zen Coast, and Chris is a big part of that as well, is we are a coaching program that will help you learn real estate, right? To help you get your time and energy back so you can spend it with who you want, when you want. So giving you a roadmap, giving you strategies, giving you the tools and processes of not only how to buy stuff, but also the strategies along the way. People like Chris, who's partners with us, people like Jennie, who have gone through this, right? And so building that mindset, being around other people who are like-minded as well, so that if your kid asks you, hey, Dad, can you drive me to school? You can say, yeah, I can, right? So we'd like to offer for anyone that wants to talk with us, you can book a call here in our QR code or go on our website here before we get any questions. And we definitely take only a handful of people every quarter, but if something that sounds like it might be a fit for what you are looking for in your life right now, we're happy to take a call with you to see if there's a mutual fit as well. So with that being said, happy to take any other questions that we have for tonight, for myself, Jennie, or for Chris. So yeah, go ahead and unmute, or I don't know, Jennie, in the chat.
Yeah, I want to really thank Chris. It is a crazy season with tax season. Like, you don't have to be here with us, but Chris is spending 2 hours of his time to really educate. And our motto is to really be able to give back. So I just want to thank you again, Chris, for being here with us. I know you have so many taxes to file, including ours. So thank you for
go back and do our taxes.
I appreciate it. Anything anybody needs, please feel free to reach out.
Yeah, and
Chris, are you taking? Oh, sorry. Are you taking new clients?
Sure. Yep. Absolutely. Yep.
How do we find you?
Calvin will be able to get you contact information and everything. We'll get something set up and get on a call.
Or just text me after this. I'll connect with Chris. And one thing that I love about working with Chris, by the way, guys, is we came up with a plan. What it was like in March, something like that, and we kept tracking it. Every month we get on a call and say, all right, where are we at right now of our plan? Like, we don't want to pay taxes this year. How do we do this? How much property do we need to buy? What does the value of these properties have to be? And every month we checked in and we executed, and Chris was basically keeping us accountable to that. And I don't know what our tax return looks like this year, but it looks like we're going to be close to.
We've chatted a little bit about this, and the execution on Jennie and Calvin's side was absolutely outstanding. So they're going to be in an enormous tax beneficial position to be able to continue to grow their portfolio. There's no question about that.
Yeah, and the point there is, hey guys, like, go talk to your CPA if it's Chris or someone else. Like, have a strategy with them, and then go out and actually execute it. Because if you don't know, it's almost like you're blind and trying to figure out how to actually use tax to your advantage. Like, the person that is across the table from you doesn't know how to do it either, and there's no plan in place, you're not gonna be able to take action on it. So go make a plan, take action on it, so that next year that we have the same presentation, you're like, hey, actually I executed on this, and yeah, guess what, I bought another property with it. Or I bought Calvin and Chris courtside seats to the Warrior final game, whatever it is.
we'll take either of those. We'll take either.
Yeah.
And I just put in the chat a great resource. It's Tax-Free Wealth by Permanently Lowering Your Taxes. It's by Tom Wheelwright. It's another CPA, and I'm not sure if you have any insight on that book yourself, Chris, but reading that, I was like, it teaches all about the cost segregation. There's so many different tax strategies as well too. So this is just part of it, and there's so much more that we want to teach you all. So reach out to us via Zen Coast University and reach out to our team here.
Awesome. Well, thanks so much, everyone. Have an excellent night, and we'll talk then.
Sounds good.
Thank you, guys. Thank you.
Okay, guys. Bye.